like to open it up by talking a bit specifically right now with Andy about his extraordinary business, a 14-year track record of success, and to try to figure out for all of us in the audience, either trying to build a hedge fund, launch one for the first time, partner with a few to spin out from an existing firm, believing that they too can be the next Avenue or the next White Box. How does one do it? What is that secret sauce? And I'd like to turn to Andy now to ask, how can other firms achieve what he has achieved at White Box? Andy?
Well, I think the secret to our success is organization and culture, which I thought about a lot when I established the firm, and ongoing. I think any organization, but particularly a somewhat complex financial organization of any size, has to deal with the question of how do you handle more information than one human being can. So our multi-strat fund has 800 positions, 2,000 securities. Obviously more information than one person could assimilate or handle. So how do you how do you deal with that? And also, how do you get both coherence and diversification, which might seem to conflict with each other? There are a couple of things that are, I think, really unique about White Box on that front that I believe very strongly, and at least for us. First is we have 35 investment professionals. 22 of them can make a trade on the wire, on the phone talking to a broker, buy or sell something. Don't have to ask anybody's permission, don't have to go through committee. And yet none of them have an individual P&L. And none of them even work for a single fund. Their trades could go anywhere. And I think that's part of getting diversity, and it's our sort of answer to the information problem and process. So everybody knows more than their own positions, and they overlap, and we try and build a sense of responsibility for the integrity of the portfolio as a whole, and not your silo, your group of positions. People say, well, how can you be, how do you get accountability or what have you? And I'd like to give the analogy of an NBA team. If it would be possible to organize that team and reward everybody based on how they did in their individual matchup. And so everybody's goal is to score more points than the guy they're guarding. And if everybody did that, of course, you would win every game. But you wouldn't get the best team. And you wouldn't necessarily be tracking the right things. You wouldn't sort of figure out how to get the most W's, which is what you want.
How do you do both? You just talked about diversity as well as culture. How do you manage both of those simultaneously?
Well, so 22 people. Actually with fairly diverse backgrounds. So, people think of us as a mathematical shop, but more than half the people at White Box are not good at math, come from a whole variety of backgrounds, firms, investment banking, industry, et cetera. Some new out of college have only been with White Box. To get coherence, we have a set of 10, what we've distilled to 10 investment principles, which we try and get everybody to internalize, which is sort of the common core. The first of which is, sort of we believe that risk is not the source of return, but rather return comes from the efficient elimination of risk, the efficient reduction of risk, which is, that's not a principle like whenever you can set up a differential equation, that only people of a particular mindset and background could apply or think about. It's something that people can think about whether they came from industry or they came from investment banking or they came from trading derivatives at another shop.
Right. Makes sense. Speaking of risk, Mark, most institutions today, when you look at everything from an RFP to the discussion with investors, especially pension consultants, they identify hedge fund risk now to be 4 different types of risk, which is investment, headline, business, and operational risk, all of which are themselves completely distinct. And so the obligation now when coming into a meeting or closing business is to justify and verify that you've actually structured the processes and infrastructure to sustain and ultimately solve for those issues. What do you think the biggest risk is for hedge funds today in that context?
Well, I still think the biggest risk is your investment risk, right? At the end of the day, nobody is going to invest in you if you don't do well. So I think the first thing you've got to do is actually be a really good asset manager or be a great asset manager. And I think that's exceptionally hard, right? That's what everybody wants to do. You're in a zero rate environment and you've got to generate, at least today, you've got to generate around 10 or 15%. And then I think from there you sort of move on to, I think, operational risk. Mm-hmm. And I would say, one of the biggest growth areas in our firm is compliance. And part of that is you want to make sure that you've got no issues. Mm-hmm. And I think today you're at a bit of a zero tolerance environment where people don't want to have any issues. So I think it's forced firms like ourselves and like you to make sure that you've got best in class in sort of everything that you're doing. Mm-hmm. So I think for people who are starting out, that's very hard because there's a huge amount of cost in doing that.
That's right.
And I think as you get larger, you start spending that. But I think for firms that are starting out, it's actually pretty expensive.
I was canvassing some of the audience today, and the big challenge they wanted to ask you specifically is, I'm $50 million, and I need to do all of those things to get to $500 million. What are the options? Some are saying seeding or anchor, others are saying outsource everything. I'm sure you have so many hedge fund managers coming to you, potentially that size, saying, how do I grow when I don't have the perceived infrastructure to justify institutional growth?
Well, look, I think at the end of the day, people will give you the benefit of the doubt, mm-hmm. right? If you've got 50 million, I think, again, it's going to be about performance, right? When you're small, the one thing you're always going to say is you're nimble, you're quick, mm-hmm. you're able to sort of outperform because you can pick and choose. And I think that's great, but then you've got to be able to do that, right? So if a large firm or a large fund is generating sort of or having a 10, 15% return, and you're running 50 million or 100 million, it's kind of hard for you to be generating those same returns. Because if you do, I don't think then people will pay attention to that. And the reason they won't is just then they don't want to take that operational risk, right? They don't want to take sort of the franchise risk. So people are not, or investors are not going to want to take those risks unless they think they're getting compensated for that. Right. So at the end of the day, I would say to you, if you're managing 50 million or 100 million, focus on producing stellar returns. And if you've got those stellar returns, then people will give you the benefit of the doubt and say, okay, well, we understand you can't sort of do all these things because of your size. But then as you grow, you'll end up doing that. And I don't mean to sort of always go back to it, but it really ends up being about returns. Mm-hmm. If you're able to produce, I've never met a manager who's been able to raise money being down 10% a year for the last 3 years, right? It's kind of hard to go out there and say, I'm sorry about the last 3 years, but this is my year. Mm-hmm. This is when I'm going to make it. So I do think you've got to produce, and as you produce, people then start giving you more benefit of the doubt.
Right, that makes sense. Andy, we were talking about your investment principles and getting coherence. Could you talk a bit more about your investment principle and how you came up with building White Box the way you did?
Well, the biggest thing about building White Box, when I left Deep Haven, I took a lot of time and I thought about what kind of firm would get the best out of me, mm-hmm. what environment could I work the best in, and I actually thought it's more important to get the best out of the people you have than have the absolute best people. because everybody's capacity is so much more than what they actually achieve. So if you can take, if across the organization you can take an average person and make them above average, an above average person and make him very, very good, and a very, very good person and make him an absolute star, that's what I thought would make the firm successful, and I really did think about it was introspection and extrapolation, which I guess the technical term for that is narcissism, but that was sort of my process. Look at me, look at what I want and so forth, and as we really do take it seriously, and as we've hired people, I said, the first thing is, are they a nice guy and do they want to work at White Box? And then, will they fit in a horizontal organization, which is to say, they have to be sort of comfortable, both up and down in an organization where there's not a clear funnel and hierarchy and structure. And one of the things I'm sort of proud of is when the New York Times did a story on us, a reporter spent 3 or 4 days with us and says, I'm in a room with 30 people and 5 of them are multimillionaires, and I cannot tell you who those 5 are. So there was another, what was
No, that's right.
What was
That's
the
perfect.
other part of the question?
No, just how, that's exactly the question. That was the question. We were just talking about investment principles for White Box. What were the guiding investment principles that you thought through that still are the totems that would be on your wall when thinking about what Avenue is that you keep coming back to?
No, look, I think at the time when we started Avenue, the goal was, and look, and it sounds hokey, you want to, and it's a little bit of what Andy talked about, it's you want to be the best that you can be. So you ultimately end up, we thought if we could understand a company as well as anybody, and that we wanted to pride ourselves on research, on credit work, that if it's a little bit different than sort of your model, and that our view was if we could know 25 companies exceptionally well, we should be able to do really well, because you can't sort of find 50 or 100 or 200 companies. It's kind of hard for us to do the work on all of those. So if you could do the work on sort of 25 to 50 companies, know them exceptionally well, that you would do well. And you just had to work harder, and you had to know more than others. And the way you were going to do that was by meeting with the companies and doing work that others just weren't willing to do. And it's just putting a huge amount of time. And I think the firm has grown because of that. I think we've got an excellent credit team that's done a great job over the years. And I think that's how we've grown.
Do you think that because they're a better part of, I think the last I read, 1,100 hedge funds launched in the last 12 months alone. Granted, there's natural attrition and it may well be equal, but of the new ones coming in, a lot of them are thinking about seeding or thinking about anchor investing. What advice do you have for people in getting early chunk capital to start igniting their business? Or do you think, based on your earlier comment, that maybe returns, assuming they put their head down and really can demonstrate a long-term demonstrable track record, that could well be enough without needing seed or anchor?
Look, it's hard. I think it depends on the individuals, right? There's some people who don't want to wait and sort of feel I need to get going right away, so you're going to go do a seeding, and the seeding gives you 100 million or 200 million. And if you talk to people who ended up doing seeding deals, at least the guys I've talked to, they sort of find that at the end of the day it was great to have the capital, but there wasn't a lot of synergies, right? There wasn't a lot of benefits to the seed other than the capital. And I think that's great, right? But look, the problem you have is the first question people ask you. If you say, what do you do? I run a hedge fund, right? Or, first question, today the first question is, how much money do you run, right? nobody says what strategy, or what kind of strategy, what were your returns? The first question is, how much money do you run?
Always used to be, what's a hedge fund?
Oh, yes. What's that? But now, so if you say you run 50 million, right, people go, oh, I'm so sorry, right? Or they move on, and they don't want to pay attention to you. And if you say you run $1 billion, everybody goes, oh, wow, I want to talk to you. So, and if you say I'm a lawyer, which is what I usually do, they go, oh, I'm so sorry, and again move on. But look, part of that is this is where you are, right? And you're in an environment where people are very focused on sort of the size of what you're running. And part of the problem ends up being that if you're running 50 million or 100 million, and you've been doing that for 2 or 3 years, somebody will come to the conclusion, well, the reason you're not running a lot is you can't be that good, right? So I think at the end of the day, look, it's a business, and you've got to hire the right people, and ultimately, you've got to do a good job of generating returns and explaining what you do so that people will end up investing in you. Everybody wants to run a hedge fund. The dollars are great. I mean, I think you have a huge amount of freedom, but I think it's very hard to build, and I think it's gotten harder. And I think if you want to be successful in this business, you're going to have to produce, and you're going to have to do a better job than people who are larger than you, right? And you sort of see a number of people who've grown and who've done a great job, and then other people are sort of stuck where they are. And if you ask them, well, what's the problem? Everybody will tell you, well, it's not my fault, right? I don't know. Investors don't really understand what I do. And I always want to say, well, if they don't understand what you do, kind of hard for them to invest, right? I mean, or investors, don't want to give me the benefit of the doubt, or investors want me to be up every month. I mean, whatever it is, you hear sort of every excuse. And I think at the end of the day, it's a very, very difficult business to succeed in and to become large. But if you do, I think you'll find that it's going to work out exceptionally well. But it's a lot of time and it's a lot of work.
We were talking earlier, Andy, about collaboration, that arbitrage is a team sport. Maybe you could expound on that a little bit, about your collaboration and how your team works together in that construct.
Well, we sometimes talk about the AMR LCC deal that just closed, which is something I don't, there's a situation where Justice Department, or maybe it was the FTC, government opposes a deal that everybody thinks is done, and had a pretty good spread before. The spread widens out to 10-12% on USAR, 17-18% on AMR, and the debt securities in AMR trade as if there's no chance of a deal ever being resurrected, or basically at what we thought was ongoing non-event value. Well, that was kind of credit analysis. That was sort of understanding the sort of debt capital structure, and where it was apt to be in a standalone entity. You had that element. You had the bankruptcy element. You had a sort of somewhat complicated payout structure over time, which had some sort of option elements to it. And you had LCC that became hard to borrow, and we ended up selling some LCC options, and selling a basket of airline stocks. So it was sort of picking sort of the right match for that. Really a situation where you would not expect any one person to have had a lot of experience in all of those elements. And yet, when they settled with the government, It really was a done deal. I mean, as to the extent that any risk arb is ever done until the day before it closes, it really was. There was nothing left to do, and yet there was still a gargantuan spread. 10% in LCC and 17% in AMR, and we were able to. One of the nice things about the environment currently is sort of in the old world, you might have had 3.5 minutes or less after the settlement was announced to figure out exactly how you're going to price everything and so forth, and then the market would get it quite right or maybe overshoot or what have you. Spread was extraordinarily persistent. You had sort of days, it went from 17% on AMR to 15 to 12, and it was 6, before it closed. But we thought sort of we were able to get on top of it, to be in the right part of the capital structure, to hedge it appropriately, fairly quickly. And it was sort of 4 or 5 people at the firm fairly involved, and it did end up in a lot of funds. It was one of the best trades of forever.
Right. Mark, to that end, is there an example? I think so many people thinking about their edge. It's the first question you have in every meeting these days. Besides it used to be what's a hedge fund. Now and then the next one after that is how many assets, and then after that people cut to the chase because they're either bored or they've got 20 other people they have to see, and they just want to get to the punchline, which is, what do you think your edge is? That oftentimes with investment principles, because one would hope that your edge didn't change that much. It might be a new trade or an idea or growth of business, but by and large the core of that stays the same. Can you give an example just for the audience in thinking through, what is an example that you use to show a competitive edge that is distinct to you, that might inspire a new marketer to think about what that would need to be for them? Sure.
Look, I think at the end of the day, I always marvel at that question, because I do think it's a great question. But if you sort of think about it simply, every day, take Apple, right? I mean, it's a great company. We all have an iPhone, or most of us do. I still have my BlackBerry. But every day, 1 million people buy Apple and 1 million people sell it, right? And everybody who's buying it thinks it's going up, and everybody who's selling it thinks it's going down, and somebody's going to be right in 3 months. So what we try to do is sort of invest in situations where you don't have that ability, where you can't have that many people trying to invest in that. And the reason for that is usually because of liquidity reasons. So we try to find situations in different parts of the world where you can do that. A classic example of something like that is in Spain, where today, construction company will go out and build a school. And they build that school, and then they're owed money by the town. And if the town doesn't pay them, then they're owed money by the city. And if the city doesn't pay them, they're owed money by the state. And if state doesn't pay them, then they're owed money by the federal government. It's an obligation, really. So when somebody does work for you, it's an obligation of the federal government. And the sovereign debt of Spain trades today around sort of 4%, 4.5%. And what we've been able to do is buy those obligations. So the construction company or anybody who's doing business with a city agency, the problem in Spain today is it takes them about anywhere between 6 months to 3 years to pay you. And when you're running a business, kind of hard to sort of run your business when you sort of know it may take you 6 months to 3 years. So you've had this other market that's developed where people buy those claims. So for someone like you, it's kind of hard to do because you don't have 10 or 15 people working for you in Spain trying to source that debt. And we're able to buy that debt anywhere between 60 to 80 cents on the dollar. So if somebody said to you, would you like to buy sovereign debt and buy that sovereign debt, which trades at par and gives you 4%, would you like to buy that at 60 cents or 70 or 80? The answer would be absolutely yes. So then the next point is, okay, go find it, right? So I think it's part of what we try to do is in a number of situations provide liquidity to people who don't have liquidity. In AMR, I mean, I actually agree with Andrew, it was a phenomenal trade. We were buying, at the time, we were buying either trade claims or equipment trust certificates or the bonds, and we thought we were creating those at a discount to where the market was. And when, in essence, Justice Department came in, if you had done your work and you felt pretty comfortable, you sort of knew that at the level where everything was trading, that even if a deal didn't happen, you were going to be fine. You wouldn't make any money, but it was kind of hard for you to lose money. So a lot of, I would say, and I know it sounds boring, I would say our edge is exceptionally hard work. I think it's getting to know a situation very, very well and taking advantage of situations where people need liquidity. And if you're able to do that, you'll be able to sort of do pretty well.
The question I'd add on to that is, how do you prove sustainability and repeatability of that process? Because the biggest issue for a lot of investors today comes up to that. It's accountability, transparency, that's still happening, but it really comes back to the repeatability of what it is you're outlining. How do you walk through the evidence to someone who may not know you, how you actually have demonstrated that?
Look, a lot of it is you sort of look at, when you look at the world, there's always areas of the world where there's a lot of issues. So today, US, less issues. Europe, huge amount of issues. There's a huge amount of deleveraging that's going on. So what do you have in Europe today? You have a lot of non-economic sellers. You have banks who have to sell loans. So I think when we're talking to investors, part of what our job is to sort of explain to them, look, in this part of the world today, you've got a lot of non-economic sellers. You've got people who need to sell and are more focused on cleaning up their balance sheet than they are on what the actual price is. And I think you had that in the US in 2009, 2010, after you were coming out of the crisis. You had that everywhere. But in 2009, I would not have told you that everything would be fine within 2 years, right? That sort of markets would come back. I would have thought it would have been a 5-year process. And if you sort of look at it, it literally took about 2.5 years. Europe, in my opinion, is something that's taking about 10 years. I mean, there is a huge deleveraging. It's going to take time. You're constantly able to buy debt at prices, mainly because there isn't a lot of liquidity. There's more and more capital that's being raised, but you've got literally about $2 trillion worth of paper that's being sold there, which you can buy and generate some pretty decent returns. So the sustainability of all this is the good news. Is there's always the markets change, and when Asia was doing great, Europe was having a hard time. When US is doing better, somebody else is having a hard time, and you sort of find that you're able to take advantage of that. And depending on sort of the supply side, you either raise more money to take advantage of that situation or not. I think for us in 2011, as we started seeing the opportunities in the US go down a little bit, we returned about $10 billion worth of capital. So, that was a huge decision on our end to return $10 billion. And we did that because we had seen a lot of the things we own had moved up to close to par. I think what's happened now is, especially in Europe, because of sort of what's going on, we're raising additional capital to take advantage of those situations.
Perfect. Andy, you've built a global business. How do you and your partners work together in that collaborative way to come up with an investment idea or that type of decision yourself?
We're not that global. We are really U.S. centric, and it does sort of come down to being a flat horizontal organization of intellectually curious people. And I think, you talked about sort of sustainable edge.
Right.
We do best in complex situations. We do best in sort of evolving situations, changing situations, something that's new. And I think sort of the reason is that there really are 22 people that can provide input. If you take in a hierarchical organization, you think your boss is making a mistake. You think your boss is not getting something new, or not seeing something because you have some particular experience in this area that he doesn't. Like sort of a lot of organizations, you can talk to your boss. You can you can tell your boss, you think this is wrong, and this is what you think. In no hierarchical organization can you talk to your boss's boss. And talking to your boss's boss is an extraordinarily risky thing to do, and it's a huge violation of protocol. So you get situations like the London whale. Lots of people walking the streets of London knew about that and knew J.P. Morgan was losing a lot of money in this whatever with IG. Well before Jamie Dimon did. Sort of. And I think we get an advantage in information processing because it's 22 and not 1. In the basketball analogy, if you're paying everybody based on 1-on-1, the problem is you'll always be playing 1-on-2 or 1-on-5 or 5-on-1, and I think we can really process information faster because of sort of the flatness of the organization. There are other things about the organization. People will say that, but does it fit with them? Can they do it? There are things. 14 years. I have never, not once, not twice, but 0 times have I raised my voice to an employee. 0 times have I publicly or privately, humiliated an employee or tried to embarrass an employee because, I don't think whatever satisfaction I might get out of raising my voice or whatever, sort of, motivational charge, which wouldn't work for me, so I don't really believe it would work for somebody else. Somebody might get or what, motivation they might get to try and avoid being, I don't think it's worth the cost of blocking off that flow of information. Sort of another thing, absolutely, I believe unique about White Box. We have no deferred compensation and we have no non-compete agreements. So if somebody has a better opportunity, I wouldn't wish them ill if they took it. So that's a challenge to me to make sure that this is actually the best place for them.
How did you think to build that type of, Andy, how did you think to build that type of business? You've seen so many different businesses from Deep Haven onward. There are a lot of different formats that you could go down. How did you build it, and why did you think to build it this way?
Getting back to the narcissism theme.
It worked for you guys.
When my partners at Deep Haven and I were sort of splitting up and fighting, they didn't like the way I'd handled the '98 crisis or what have you, and we had desperate businesses and so forth. So they sort of said, "What you did a lousy job, and we need to punish you, or you need to leave, or what have you." And so I said, "Oh, fine. If you don't want me, I don't want to be here." And then they said, "And by the way, the non-compete that we all agreed we would sign but didn't, we want 3 years of you doing absolutely nothing. Maybe you can manage your own money, but and I just thought that was grotesque. That wasn't right, and I just always thought, you want people that want to be there, and if it's not right for them, it's not right for you, and it really was just a reflection of how I wanted the world to treat me.
Right. It's lovely.
Look, I don't mean to simplify this, but when you sort of talk about this stuff, the reason, when you sort of say, whether it's a flat structure or however structure, at the end of the day, all of us, every fund manager you're going to meet is going to tell you he's special. He's then going to tell you he's unique. He's going to tell you he's different, and that they don't take any risk, right? And pretty much, and the part that nobody really wants to talk about is at the end of the day, there aren't that many people who are that special and who are that unique or who are that good, right? So the only reason Andrew could build the firm that he did is because he's really good. And whatever structure he's put in there works, and the people who are there are very talented. And everybody who hires somebody believes, I would tell you the people we have are the most talented people on the street. Andrew's going to tell you the people he's got the most talented, and you'll sort of go to everybody you meet. But ultimately...
No, I wouldn't tell you that. I'd say, they're, maybe they're comparable, maybe yours are better, maybe. I think the people at AQR are smarter than the people at White Box, but White Box is better than AQR in part because we get sort of more out of them.
So you get more out of them, but ultimately it's going to be about the returns, right? The only way you can grow, the only way you get to be a large firm is you've got to have been successful from a business standpoint, and you've got to be successful from an investment standpoint, right? I mean, I actually have the same philosophy Andrew does. If somebody wants to leave, they should leave. Right. I mean, at the end of the day, you either have a firm where people want to be at, or you have a firm where people don't want to be at. And if people want to be at your firm, then they'll stay and you'll keep on growing. But you can't grow unless you've actually been right more often than not. And what ends up happening is we all sort of meet and talk to the people who've done very well, but the reason they have is they've actually been able to create these firms, and they've been able to grow these firms. And for whatever reasons, that talent mix and how it's been brought together is able to produce, right? And that's what enables these firms to grow, is that you've been able to sort of produce at a level and sustainable over years. And that's the hard part, right? I mean, you can't grow to sort of $1 billion or 2 or 5 or 10 unless you've been able to generate returns over a long period of time, or unless you've been able to sort of do things that others haven't been able to do.
I tell people often, as a mentor to people in the business over 20 years, that I've been almost nearly completely unqualified for most of the jobs that I initially got, but it was a matter of gumption, hard work, tenacity, listening well. Give me an example of someone that you meet that you just know has the DNA strain that would make them an Avenue employee, where you look at them and you say, they may be well qualified conceptually, but you know that there's something there that's worth investing in. What are the characteristics and behaviors of someone like that? It might be eclectic.
No, I think rule number one is you need to have somebody who's very bright. Right. Right. I mean, it's. I don't think we try to hire knuckleheads. So we try to hire people who are very bright. But then you want people who you believe or you think have the ability to succeed, and you sort of find out over time. And what you have over time is you have people they're all very bright, but for somebody to make money, I think that's actually a whole other level. And, we have people who would tell you if the market is 60, 65, I happen to think we should definitely buy this, we should buy it at 55. And, when the market goes down to 55, they're a buyer at 50, right? You sort of find, it takes, there's a certain personality that sort of says, look, we need to buy it. And I think it's great that you've got 22 people who can do something like that, right? But the ability to sort of do that, I think, is really hard. Right. And I think when we hire people, we sort of hope they'll have that ability. And if they get there, I think it's great for us. Right. And if they don't, then what they are great analysts, but they're not going to end up being your portfolio managers. And sort of giving somebody the authority to buy something, you've got, I think everybody who starts at the firm believes they can do that. And then over time, you sort of see the people who can. And those people are the ones who end up, having more and more authority. because they've been able to prove it.
Yeah, one of the things I strongly believe is most of the challenges of investing are not cognitive, are not intellectual, they're psychological. They're the ability to do something consistently, to both make decisions with conviction and change your mind in the face of new data. You know, so it's really important to have an organization that works psychologically, that sort of helps psychologically. It's also, you know, on the business side, if it's going to work, it has to fit with you, and it has to be what you believe as opposed to what they believe. You know, they say you need to do this, or they say you need to do that, and if it's not you, it won't work. Not because what they say is wrong exclusively, but you won't be able to stick to it. You won't be able to do it consistently. You won't portray authenticity. You won't, going back to the word, you won't have coherence.
So what do we think our industry looks like in these coming years? Is going to be more and more consolidation? Is it going to be harder and harder and harder for small managers to actually do what it takes and have what they need to survive? What does it look like in your mind's eye?
I think it's harder. I think 5 years from now, there'll be more consolidation. I think investors today, at least where the large money is coming from pension plans, I think they want fewer managers. I think at the end of the day, they want to take less risk. And what I mean by that is sort of less franchise risk, less operational risk. So I do think it'll get more difficult. But doesn't mean that people aren't going to be able to succeed. I mean, it's the fact that it'll be harder, it'll be a little bit harder, and I think for firms like ourselves, it'll be harder too. I mean, it's not, I think there's a huge amount of pressure on our industry and on folks doing what we're doing. And I think in the past you had more luxury of time. I think today you have less luxury of time.
Good point.
I think today, I would say to you 5 years ago, if we had a bad year, you could explain and say, well, look, trust me, I think this, and people give you more time. I think today, I think there's just more pressure on the pension plan, so therefore there's more pressure on you. But you'll always be able to find people. There's always people who are going to do well. I mean, there just is. Right? And those guys will succeed. I mean, I think Boaz Weinstein, when he left, I think within a year or 2 years, he went from sort of 100 million to sort of 3 or 4 billion. I mean, so you've got examples of that, and people who are really good are just very good. So I think it'll get harder, but so what?
One last question, Andy. A few people have asked before coming to the room. What does White Box mean? What is the derivation of the name?
Well, the opposite of a black box, which is the idea was to be sophisticated, but
in the light,
transparent. And one of the things I've always thought black box. Most black box sort of pitches I find a little bit dishonest in that part. They're sort of saying either what we do is so profound, so profound but simple that it has to be a closely guarded secret. Otherwise, once it's out, it's all gone, and that's not true. Or it's so unbelievably complex and intricate that you couldn't possibly understand it even sort of schematically, so we're not going to do that either. And that's usually not true either. So that was the contrast I was trying to draw.
Makes perfect sense. Perfect. Any last words?
If you're starting out, good luck. And if you're not starting out, congrats. You started it 5 years earlier. So, yeah, that would be it.
That'd be it?
I don't know.
Great. Well, with that, please join me in thanking my esteemed panel, Andy Redleaf and Mark Lasry, for their time. Thank you very much.